All right, let's jump right in. Have you ever really stopped to think about what makes a good investment, good? Well, today we're basically going on a quest to figure that out. We're going to cut through all the confusing jargon and give you a kind of map, a simple guide to understanding what your money is truly worth.
It all starts with this one question that, let's be honest, every single one of us has to face at some point. You've worked hard, you've managed to save up a little extra cash, and then you're hit with the big, so now what? What's the smartest thing you can do with it? I mean, sure, you could just stash that cash under the mattress. Safe and sound, right? But here's the catch. That money, it's actually in a quiet battle it's losing. A year from now, that $100, it might only buy you what, $97 worth of stuff? That's inflation for you. It's like a silent thief. And investing? Well, that's how you fight back. It's making the choice to send your money on a journey, with the goal of not just keeping up with inflation, but totally leaving it in the dust.
So, here's the game plan for our quest today. First, we're going to start with the absolute basics, why investing is way better than just saving. Then, we'll get into the two big kahunas, risk and return. After that, the main event, how to figure out what a stock is actually worth. We'll look at two different paths analysts take to find that out. And finally, we'll wrap up with why building a whole team of investments is really the ultimate prize.
Okay, let's kick off this journey. When you boil it all down, investing is really about one simple choice. Do you want to spend your money now, or do you want to let it grow so you can spend a whole lot more later? That's the trade-off.
And this formal definition here, it really hits the nail on the head. You're putting your money in now for a certain amount of time, with the expectation, the hope, really, that you'll get more back later. But that raises a big question. What exactly are you getting paid for?
And that question, it brings us right to the two most fundamental, most important concepts in all of finance. I mean, every single investment decision you will ever make boils down to these two ideas, risk and return.
See, that payment you get, that return, it isn't just some random profit that appears out of thin air. No, it's actually compensation. And it's for three very, very specific things.
Think about it like this. First, you get paid for your patience. That's for the time your money is tied up. Second, you get paid to make up for inflation trying to eat away at your money's value. And third, you get a little something extra, a bonus, called the risk premium, basically for being brave enough to deal with the uncertainty of it all. So time, inflation, and risk, those are the three key ingredients in any investment return.
Okay, but before we start looking into the future, it's absolutely crucial that we know how to look back correctly. Because trust me, if we mess up how we measure past performance, it can lead to some seriously bad decisions down the road.
Let's walk through a classic example. Imagine you buy a stock for $50. In the first year, it just skyrockets to $100. Amazing, right? That's 100% gain. You're feeling like a genius. But then year two comes along and oof, it drops right back down to $50. That's a 50% loss. So my question to you is, over those 2 years, what was your average return per year?
Okay, so check this out. If you just do the simple math, the simple average, what's called the arithmetic mean, it tells you that you made an average of 25% a year. But did you really? I mean, you started with $50 and you ended with $50. This is where the geometric mean comes in. It's kind of the pros tool. It gets that a 50% loss completely cancels out a 100% gain. And look, it gives you the real answer, 0%. This isn't just math trivia, folks. Understanding this difference is absolutely crucial and can save you from making some huge mistakes.
All right, so all of this brings us to the absolute core question of our entire quest. Let's forget about past prices for just a second. The real treasure we're hunting for is the answer to this. How do we figure out what an investment is truly worth, right here, right now?
The secret, the key, is this concept called intrinsic value. And what that means is that a stock's real worth isn't the number you see on the screen. No, it's the sum of all the future cash that company is expected to generate. So what you do is you estimate all that future cash and then you discount it back to what it's worth today. Think of it like this. Discounting is kind of the opposite of compound interest. It's just a way to account for the fact that $1 you're promised next year is worth less than $1 you have in your pocket right now.
Okay, so that sounds great in theory, right? But how do analysts actually do this? How do they go about estimating this intrinsic value? Well, in the real world, there are basically two main paths they follow, two different kinds of toolkits they use for hunting down a stock's true worth.
Yeah, you can think of it like two different kinds of detectives on the case.
On one hand, you have the discounted cash flow detective. This one is like a forensic scientist, you know? They're trying to calculate a very precise value based on the company's own DNA, its future cash flows. On the other hand, you have the relative valuation detective. This one is more like a savvy comparison shopper. They're looking at all the other similar companies on the block to see what they're selling for, just to figure out what a fair price is.
And one of the most famous tools that our comparison shopper detective uses is the price-to-earnings ratio, or PE ratio. You've probably heard of it. It's actually a pretty simple metric, which is why it's so popular. All it tells you is this: for every $1 of a company's earnings, how many dollars are investors willing to pay for it right now?
So you might be wondering, what makes a PE ratio high for one company and low for another? Well, it all boils down to expectations. It's really driven by three key things. Think about it. If everyone expects a company to grow like crazy, they're going to be willing to pay more for its earnings today, right? That pushes the PE up. But on the flip side, if a company seems super risky, investors are going to demand a higher potential return to make it worth their while, and that pushes the PE ratio down. It's this constant tug of war between growth expectations and perceived risk.
Okay, so we've just spent all this time learning how to value one single investment. But here's the thing, the investor's quest doesn't just end when you find one shiny piece of treasure. The final step, and honestly, this might be the most important one of all, is about assembling a whole team of investments.
And the whole idea behind this starts with a really simple, really human trait. For the most part, we are risk-averse. We just don't like uncertainty. I mean, if someone offered you two investments that are expected to give you the exact same return, you'd pick the less risky one every single time, right? Of course you would. We're only willing to step up and take on more risk if we feel like we're being paid extra for our trouble, with a higher potential return.
And this simple idea leads to one of the most powerful concepts in all of modern finance. A truly great portfolio, it is not just a collection of individually great investments. The real magic isn't about finding the best individual players.
It's about how those players work together as a team. A good portfolio is a collection of investments that are good together. See, the real goal is to combine different assets that don't all move up and down at the exact same time. You want some that zig while others zag. And that, well, that leaves us with the ultimate question for any investor. It's not just about, is this a good stock, but about your entire portfolio. How does your team work?